Hey everyone, Andy here. Let's talk about the Social Security tax torpedo. Sounds juicy, right? I personally don't like the term tax torpedo. It's what it's commonly called, but I think it's a little bit sensationalist, and I'll explain why. But basically, in a nutshell, the gist behind the tax torpedo simply means that the amount of your Social Security that's ultimately taxable federally is based on how much other income you have, such as dividends, interest, pensions, IRA distributions, capital gains from selling things. All else equal, the more other income you have, the more of your Social Security may be pulled into being taxed. So the torpedo concept, torpedo is something goes down, dives down. The torpedo concept is as you have additional sources of income, like IRA distributions, for example, that can pull more and more of your Social Security into taxation. It actually, I guess, dives up your taxable income, but it's a downward scenario that you're paying incrementally more tax for each additional dollar of other income you have that's not Social Security. And I have a table to show this that I'll to help explain this better. So there's a pretty complicated formula, convoluted formula, to determine how much of your Social Security is actually taxable. It's based on this measure of income called provisional income. I have a separate video all about this that walks through it in great detail. You can find a link to that video in the notes to this video, so definitely give that a watch. But at super high level, there's the provisional income formula is half of your Social Security, your gross amount of Social Security. Take half of that plus your non-taxable interest, such as municipal bond interest, and all of your other income, pensions, IRAs, and capital gains, dividends, interest, etc. Add that all up. That's your provisional income, and then you run that through. There's a couple different tiers of income, and based on where your provisional income falls within those tiers, that dictates how much of your Social Security is federally taxable. The amount of Social Security that is able to be pulled into taxation at the federal level is anywhere between 0%, or at most 85% of your Social Security benefits can be considered taxable income federally. Now, at the state level, very different. Nearly 40 states, of states that have income tax, nearly 40 of them don't tax Social Security at all at the state level. Those that do, you may not necessarily pay tax. It may be based on how much other income you have. Similarly, I'll not touch on that here because there's different states, different rules. But for the most part, Social Security is not state income taxable. It's just federal income tax that I'm talking about today in this video. So again, check out that video, is Social Security taxable? That'll walk through the provisional income and the actual income levels and how that all works. Just know that there's this sort of scaling percentage, anywhere from 0 to 85% of your gross Social Security benefits may be pulled into federal taxation based on this convoluted formula that's beyond the scope of this video. But it explains it more in the other video that I'm referencing in the notes here. So I'm about to show, I'll pull up a little table here to help bring this all to life and show some real live examples. Take a look at scenario 1. Now, this is for a hypothetical single taxpayer, so filing a single tax return, and the person is 65 or older. Why does that matter? It just matters simply for purposes of standard deduction. If you are 65 or older, the amount of your standard deduction is slightly higher than the normal standard, if you will. So for 2022 tax year, a single 65-year-old, or someone who's 65 or older and is single, standard deduction is going to be $14,700, which is that column D you can see on this chart. So let's start with row 1, scenario 1. In this example, the person has $40,000 of gross Social Security benefits, which is pretty good. The person must have delayed till closer to 70 and therefore is getting over $3,000 a month of Social Security, which is higher than average, but it is quite possible. I have seen many people who get that much Social Security, especially those who delay. So, and the other sort of variable I'm playing with here is IRA distributions. In this example, the scenario 1, the person is taking no distributions out of his or her IRA, and assume there's no other income whatsoever. It's just simply $40,000 of gross Social Security dollars coming in. The way the Social Security taxation formula works is that none of this Social Security is actually taxable. So you see this column labeled B, Social Security taxable amount is 0. So in percentage terms, 0% of Social Security is taxable for this person. And then just follow along the columns to the right. I'm just summarizing sort of what a tax return would look like. The person's adjusted gross income is 0 because there are 0 sources of taxable income. Standard deduction is $14,700. Taxable income is obviously 0. and therefore tax paid or tax owed for the year federally is also going to be zero. Now let's look at scenario 2. In all these scenarios, a person has the same $40,000 of gross Social Security, and I'm assuming no other income other than potentially IRA distributions, which is this column A here. So scenario 2, the same $40,000 Social Security benefits, but now the person's taking out a $10,000 distribution from his or her traditional tax-deferred IRA. Now look at column B. Now some of Social Security starts to get pulled into taxation, specifically of the $40,000 of gross Social Security. $2,500 of it is now included as taxable in this person's return. And just for reference, the $2,500 of taxable Social Security out of the $40,000 gross Social Security is 6.25%. So in this example, 6.25% of the person's Social Security is taxable. So following along again along the right, column C here, adjusted gross income, is simply the $10,000 IRA distribution plus the $2,500 of taxable Social Security. But if you look, that gross income is still less than the person's $14,700 standard deduction. So now taxable income is zero. Therefore, actual tax is going to be zero. Scenario 3. This is now where things start to get interesting. Instead of a $10,000 IRA distribution, the person takes a $20,000 IRA distribution. Gross Social Security is still $40,000, but now $9,600 of Social Security is taxable, which means 24% of Social Security is taxable for this person. So let's pause there and look what happened. When they only had $10,000, when they had $0 of IRA distributions, none of their Social Security was taxable. When they have $10,000 of IRA distributions, $2,500 of Social Security is taxable. When they have $20,000 of IRA distributions, $9,600 of Social Security is now taxable. This is a torpedo concept. As you can see, the more other income they have, other than Social Security, the more other income they have, IRA distributions in this case, the more of their Social Security is getting pulled into being taxed. So let's go back to the chart now and follow along again. So still looking at scenario 3, so $20,000 of IRA distribution plus $9,600 of taxable Social Security. Their adjusted gross income now is $29,600 minus a standard deduction of $14,700, and their taxable income is now $14,900, on which a single person in 2022 would have to pay $1,586 of tax. Still not a lot of tax necessarily, but look, this is a torpedo concept. The more other income you have, the more of your Social Security gets taxed. Therefore, the higher your gross income is, and ultimately the higher your taxable income is, which means the more tax you have to pay. Let's go back to the chart one more time and just look at the final example. You can really see how this tax torpedo thing could be quite pronounced when you have when you go from 0% Social Security tax all the way up to 85%. So look at the bottom row, scenario 6. Same $40,000 of gross Social Security as assumed before, but now the person is taking a $50,000 IRA distribution. That, due to the way the Social Security taxation formula works, they're at the full 85% now. So $34,000 of their $40,000 of Social Security is taxable, which means 85% of their Social Security is taxable. So let's look at column C, adjusted gross income. It's the $50,000 IRA distribution plus the $34,000 amount of Social Security that's taxable is going to be $84,000 of total gross income minus a standard deduction of $14,700, means their taxable income is $69,300, on which the tax the person would have to pay would be $10,869. So that's a tax torpedo. The amount of Social Security that gets taxed is increased based on other income you have. So while in the final example, if the original example, the person had 0 IRA distributions, they had $40,000 of Social Security coming in, no tax owed on it whatsoever. The final example, if they were to pull out $50,000 from their IRA, they still only have the same 40 of Social Security plus the 50 of IRA distribution they took out, but now their taxable income, the gross income goes from, what was it? It goes is $84,000 now. And that additional, even though their IRA distribution was only $50,000, their taxable income jumped to $84,000. That $34,000 difference is all because the amount of Social Security that's taxable went from 0 to $34,000 because of the IRA distributions that were taken. That's the torpedo. Does that make sense? So the amount of other income you take can jack up how much of your Social Security is pulled into taxation. Therefore, every incremental dollar of IRA distribution actually leads to a higher taxable income than just an additional dollar, because you have the additional dollar of IRA distributions plus some more amount of Social Security getting pulled into tax. So that's the torpedo. Again, I don't like that it's called torpedo. I think that's kind of sensationalist. You can find a lot of articles, a lot of clickbait that have like big flashing warning signs and tax torpedo, avoid, avoid. Yes, it's not cool when this happens, obviously, but sometimes you can't control it. Some people who have a lot of other income, like pensions, or if you have a lot of dividends or something that get paid off, your income, your non-Social Security income may always be high enough such that you're always going to be, or your Social Security is always going to be 85% taxable anyway. In which case, it's not really a torpedo. You're already at the top, right? The torpedo applies to folks where their income is low enough that their Social Security is, only a small portion of it is currently taxable, and by having other income, higher and higher portions of Social Security become taxable. So to those people, that's when the sort of torpedo concept comes into play. But it's not some nefarious, underhanded thing. Calling it a torpedo, like I said, kind of sensationalizes it. It's just the fact, the math of how the tax code works. May or may not be fair. I'm not taking an opinion on that. I'm just saying it's how the tax code works. It is what it is. Are there ways to avoid this? Again, if you're going to have a pension or other large amounts of income that you can't turn off, not that you'd want to necessarily, but no, you may not be able to avoid it. You may always have 85% of your Social Security taxable, nothing to do about it. If you can go back a few decades, maybe there can be some tax planning opportunity, not necessarily a few decades, but if you can go back in time, maybe there can be some tax planning opportunities. For example, Roth IRA distributions, qualified Roth IRA distributions, do not count in your gross income. So if you had the foresight, decades prior to retiring, to pump all your money into Roth accounts as opposed to traditional pre-tax accounts, when you eventually take money out of those Roth accounts, not only are those Roth distributions themselves not taxable income, but they won't pull in your Social Security into being taxed. That's why having Roth assets to pull from is usually good. Now you got to do the analysis. Was it worth it for you in the earlier days to have foregone taking the tax deferral at the time, instead paid tax to contribute to Roth, or would it have been better to contribute to Roth at the time, knowing that it's going to save you tax in the future? That's a really tough thing to figure out, because there's so many things that can change over time to nail down what exactly is the right answer. But the point is, any sources of income or cash flow you have that are not included in your gross income in retirement will help minimize or reduce or potentially completely alleviate having your Social Security pulled into taxation. So that's it. Food for thought. There's lots of other articles and information you can find on this with lots of examples. Some articles I saw cherry pick like the exact scenario of income and things to make this tax torpedo thing look as bad as it possibly can be mathematically. For the majority of people, you're not going to be at that threshold where it goes from good to really bad. You're either going to be all the way fully taxed in Social Security. You're going to be at the super low end. For those with really low incomes, Social Security, you're probably not going to pay any federal tax throughout a lot of your life, and then other people are somewhere in between. If you can manage this tax torpedo thing, great. If not, there's not much you can do about it, so don't lose sleep about it. Just be aware of how it happens, so you're not surprised if you get an extra $1,000 of income from dividends that jack up your taxes more than you thought they were going to, because what's probably happening is this tax torpedo concept where more Social Security is being taxed. All right, that's that. Hope you enjoyed this. Take care.